I want to welcome to the stage Alexey Kassabov, who is from Flaherty Salmon CPAs. He's going to be talking about taxation and cryptocurrency. Definitely a topic that it sounds very scary, and I'm sure none of us much like taxation, but it's always good to know how to abide by the rules so you don't go to jail. So can you please give him a very warm welcome to the stage?
Okay, good morning, everybody, and welcome to the second day of the Litecoin Summit. I think the morning time is sort of a great time to start the tax stuff because everybody's mind is sort of fresh, so we'll see how this goes. Of course, information in this presentation, it can be used for tax advice, and I obviously expect everybody to consult their own tax professionals. So in introduction, we'll talk about my personal background and how I got into cryptocurrency and taxation aspect of it. And we'll go into how cryptocurrency is viewed in the eyes of different regulators. We got the SEC, CFTC, and IRS. And we'll mention something about the outdated guidance, too, because sort of the formal notice 2014-21, it was provided back in 2014, which is kind of old guidance, you know, and say in crypto, it's like 3-year. It's like a lifetime, basically, you know, so a lot of things have been old by now. And we'll start with the basics of cryptocurrency taxation. We'll go into the general treatment of cryptocurrency as property. We'll touch on long-term, short-term capital gains. And we'll mention price discovery and basis issues. And consistency matters applied to LIFO and FIFO methods. Then tracking softwares, we'll touch base on that too, and after that we'll go into hard forks, soft forks, and airdrops, because that's like another gray area in cryptocurrency sphere, you know. Then we'll mention tax strategies for investors. People use IRAs, trusts, like opportunity zone funds is actually another interesting thing that's coming out in 2018. It's IRS in Department of the Treasury, it's getting everything wrapped up, and by 2018, by the end of it, we'll definitely have more guidance on the opportunity zone funds. And it's a completely new thing, and in 2018, you should be able to start utilizing the benefits of it. And now, closing remarks, I'll just go over the IRS views on cryptocurrency, and there is Accounting Association of CPAs and ABA letters that request further guidance on a lot of things, and we'll touch base on that too. And things like that include mining, basis issues, and hard forks, airdrops. You know, it hasn't been addressed in Notice 2014-21, which is kind of the only guidance that we have. You know, so we'll go into that. So a little bit about myself. I'm an enrolled agent. Enrolled agents. It's a federally authorized tax practitioner. We're certified with the IRS. I have unlimited rights to practice before the IRS. And I'll be sitting for the CPA exam next year. So, but I've been in cryptocurrency for a little over 3 years now. And kind of what led me to tax aspect of it is I probably like put all my money in crypto and realized that I actually needed some income to support that. So, and I figured, you know, accounting, cryptocurrency is sort of related, and issues with taxation, they haven't been addressed to the extent that, again, I'm noticing, citing the Notice 2014-21. So, well, general view of the cryptocurrency, basically, right now it's like the Wild West. You know, a lot of things happen. You know, people lose wallets, and people get hacked, you know, and this is sort of analogy with the Wild West, you know, if people used to carry gold in their purses and they were like personally responsible for them, and it's the same thing with cryptocurrency investors. They're responsible for safely storing their private keys, and if it gets hacked, then it's the taxpayer's responsibility, you know. And of course, then in the eyes of regulators, you got things like Silk Road and the dark web, which obviously, you know, if you're in a cryptocurrency, you know that it's a completely different thing. But in the eyes of regulators, you know, cryptocurrency and Silk Road and dark web, that's like one combined thing, which, you know, So that's the general view of it. When the CFTC thinks it's a commodity, then SEC comes out saying it's not a security, but then some tokens are clearly securities, which on the matter of the ICOs that they've been issued. And it's just a blend of things that comes together, and it's taxed as a property, so whatever. And of course, the issue of outdated guidance, it's 2014. Well, I'm not going to talk about the notice 2014 yet until we go into the basics. So as I said, the only form of guidance from the IRS that we have is the notice 2014-21. And like many tax professionals, they represent various firms. They reached out to the IRS to clarify a lot of the issues, and that's where we get the AICPA and ABA letters. And there has been no responses to those yet, so we're still waiting on that. And the notice, though, it does lay out some ground rules, like how virtual currencies are treated as property for federal tax purposes and governed by the same general principles that apply to property taxation. So an important thing to point out, though, is that the notice, it treats virtual currency as a currency that could not generate foreign currency gain or loss under. There's this section 988. And this is to answer the question that a lot of people ask, aren't cryptocurrency trades the same as foreign currency trades, similar to related property to foreign currency, right? And this notice 2014-21, it specifies that it's not treated as foreign currency, but still, you can argue that there's a potential treatment of that, and that's why we have no guidance. And another thing I wanted to point out is that if somebody wants to count how many times I say no guidance in this presentation, they can more than welcome to do so. So that section 988 that I mentioned, it has that de minimis rule of $200 per transaction. That's dealing with foreign currency. And again, the AICPA, it actually addressed that specific issue. And we still are waiting to hear from the IRS on that. So property transactions, of course, you get the capital gains and losses from when you, well, let's go back to the general property treatment of cryptocurrency transactions. So basically, whenever you trade, sell, or give it to somebody, you have to realize capital gains and losses. And gifts are different things, so we'll touch on that later. So on long-term transactions, if you hold it for more than 1 year, you realize either a 10, 0, or 15% tax on that. The short-term transactions is a little bit different because if you hold it for less than 1 year and sell it, or trade it for a different type of currency, then you are supposed to realize it's a taxable event, so you have to pay taxes on that. And short-term transactions, the tax rate on them is typically from 10, 20, and 37 at the highest. And another thing to point out, too, is that this presentation, it's updated for the 2018 laws. We had the Tax Cuts and Jobs Act of 2017. And this presentation should be up to date with the 2018 laws. And net, of course, the net short-term losses will offset ordinary income up to the $3,000 limit. And the long-term transactions will definitely be taxed at the preferential long-term capital gains tax rate. And short-term losses and long-term losses, they can be used to offset ordinary income of up to $3,000 a year, and that can be carried forward. So let's go over the basis of cryptocurrency and LIFO and FIFO methods, first in, first out, and last in, first out. Average cost, it's not as often used as well as the LIFO. People generally use FIFO because it's easier, and a lot of brokerages and banks use FIFO because it's more convenient, and that's what I would suggest people use it. So when you pick a method, though, when you pick FIFO and LIFO, you have to be consistent at it. When you use, another thing is, well, how do you discover the basis of it, right? Because you got different exchanges, multiple spots where you can dip different prices. Basically, you have to take an exchange and keep consistent with it. Like if you use Coinbase, you have to keep using Coinbase for the time, like for the period you're going forward. And of course, you have to be consistent with it. So once you decide to use Coinbase for one tax return, for say like 2016, you have to do the same thing for 2017 if you do decide to do that. Then there's an interesting thing, the double capital gain paradox, because a lot of people, if you're familiar with the tax issues around it, a lot of people think that cryptocurrency trades can be used as like a like-kind exchange, the Section 1031. In reality, though, it's well, of course, there's no guidance on that. And let's talk about the double capital gain paradox, because this is the issue that's addressing the like-kind exchange, Basically, a taxpayer that sells $10,000 of an altcoin, right? This is a random scenario. And basically, on the coins like Tron or some other currencies, you have to there are no pairs like Tron or US dollar, an altcoin US dollar pairs, because most of them are like Bitcoin, Litecoin, Ethereum markets. And that's why you have to, if you want to sell it to US dollars, you have to convert it to two virtual currencies, basically, right? So a taxpayer that sells altcoin into Bitcoin, and let's say that he sold $10,000 of it, right? And the basis of that altcoin was $10,000, so he made a $9,000 gain. Then later, a taxpayer sells $10,000 worth of Bitcoin to the US dollars, because he wants to cash out of a Litecoin. But under the first in, first out method, the Bitcoin was purchased 2 years ago, and the cost that he bought the Bitcoin at was $2,000. So in the end, on the $10,000 proceeds, he realizes $18,000 gains. So from this point, like-kind exchanges, it makes sense, because why do you want to realize an $18,000 gain on only $10,000 proceeds, And this is where the paradox is coming in. Tracking software that I would suggest using is cointracking.info. You can import activity from different exchanges, and it doesn't pick up wallet transactions, though. If you do a transaction from one wallet to another, it won't pick that up, so you have to manually enter it. But it's very user-friendly, and I haven't used Bitcoin Tax, but that's another big software. So yeah, Tax Cuts and Jobs Act of 2017, it puts a limit to like-kind exchanges, and it specifies that like-kind exchanges are limited to real property only. And this sort of cuts off the cryptocurrency implication of like-kind exchanges. But you can, if you have like a very good tax attorney, you can probably build a case up to the year of 2017 for a like-kind exchange in different tokens and whatever. And, but of course, you have to have the attorney sign off on the return. And if the IRS decides to track that down, it can be potentially problematic, So let's talk about theft losses, because it's another big thing. And people get, they ask questions on whether, if I lose cryptocurrency and if I just forget my private key, can that be deductible? And the answer to that is no. And again, the Tax Cuts and Jobs Act, I'm going to read it off to you. It says, individual theft losses not incurred in a trade or business or any transaction entered into for profit are not deductible, except to the extent attributable to a federally declared disaster area. Actually, yeah, I forgot to address FBAR. So the IRS actually responded on this one. And the IRS said that if you can show that there is an account relationship between you and the custodian that's holding the Bitcoins for you, then it's reportable in the FBAR. Basically, I just put it into two simple lines. If you hold private key, then no need to worry about that, because it's in your, you have the power of dominion over the coins, basically, right? You hold them in your own account. But if a crypto exchange in a foreign jurisdiction holds cryptocurrency for you, then it's probably reported. Again, unless you have the private key for, again, there's no guidance on that, and it's sort of a gray area. But as long as you hold the private key you shouldn't worry about that, I think. All right, so another, I think I said it 5 times by now, no guidance. The airdrops, I think that they can be treated as ordinary income because airdrops work the way that if you hold particular virtual currency, like say Ethereum, right? A lot of people hold Ethereum, and Ethereum wallets get credited different currencies airdrops, and usually they're small amounts, so you can just pick them up as ordinary income. But it is a taxable event, though, and again, all the taxable events, any transaction is a taxable event, basically, so it is what it is. Hard forks, there is, of course, no guidance on that too. And the 2 basic scenarios that we can go about hard forks is, first, you can treat it as ordinary income on the first day that it's credited to your account. Well, let's use the Bitcoin Cash and Bitcoin situation in August of 2017, I think. You had, for I think every 5 Bitcoins that you hold, you get, or for every Bitcoin you had, you get an equivalent of a Bitcoin Cash. I'm not familiar, but 1-to-1 that was. And basically, on the first day, it was before that you had futures too. And basically, the rule is that futures don't determine the market value. First day of trading, I think it was trading around $200 or $100, and then it kept going up in value. And well, a lot of taxpayers would ask, what is my basis for it then? Because multiple exchanges, they've opened trading at different times. And even Coinbase, it actually, remember the issue with 3 days? They postponed the opening of Bitcoin Cash trading for 3 days. And how do you go about that? So the second scenario is more relevant. It's you just keep it 0 basis. You don't realize any income on that. And whenever you dispose of Bitcoin Cash after, you would only incur a capital gain, but that will be taxed on the full amount. So you have to keep that in mind. So let's talk about the business and mining treatment of this. Businesses that pay employees, contractors, and officers, right? So basically, virtual currency that's paid to an employee, right, from an employer, it should be recorded on W-2 statement of wages. And obviously, it's subject to FICA, FUTA, taxes, and it's very similar to regular wages paid in US dollars that are reported on a W-2. But then the employee would be responsible just for keeping the basis. And the basis of that currency would be the fair market value at the time of the salary, basically, right, at the time that the payroll occurred. So contractors, if you hire a contractor and you pay him in cryptocurrency, if you pay over $600, then you have to send a 1099 miscellaneous. And that's normally with any dollar transactions too, but if you pay in cryptocurrency, then you do have to report that too. And if it's over $600, then it's a 1099 miscellaneous form. If it's under, though, you don't need to report it, but the person that receives the payment, it must pay taxes on disposition of it, and it keeps the basis of at the time of the payment. And then an interesting thing, though, is an officer compensation, right? Because you can sort of offer it as an incentive for an officer to work. And you can compensate them in Bitcoin. And what happens, though, it's employers offer stock options, right, at work. And if you offer Bitcoin as compensation, it's like a win-win situation. You just pay them regular wages in Bitcoin, and you can obviously buy it back later. But the employee, the officer, would later, when he disposes of it, would recognize, realize gain probably, right? If it's Bitcoin, the track history of it is just appreciating. So it's things you can consider as an employer. And yeah, for the officer, it'd be classified as ordinary income too. So yeah, let's talk about mining, because mining income that's treated as ordinary income, there are no guidance on expense issues surrounding that, but a lot of tax preparers, they've came out and said that we're going to do like taking account for deductions and expenses. And expenses range from like rent, utilities, cost of noise insulation too for like the fans that heat off the mining, cool off the mining equipment. And also there is this issue of passive or non-passive activity. And there is, of course, no guidance on that, but Section 469 can be used as a reference. So if mining is a trade or a business, then it's subject to self-employment tax. And interestingly, though, both active and passive miners, they may generate ordinary gains. And that's as a result of basically when you sell virtual currency to others. And that's because the currency you mine can also be treated as inventory. And that way the sale will trigger like unexpected ordinary gains. So let's talk about the tax strategies for investors. Of course, yeah, my advice is just HODL. Of course, you have to keep in mind the hard forks, airdrops, and things like that. But you won't have to deal with reporting every single transaction. Even if you convert, well, you see, the thing is, if you convert even Bitcoin to Litecoin, that's a taxable event, and you have to pay taxes on that. So loss harvesting, realize losses when you can. Good thing about cryptocurrency trades is wash sales, they don't apply to cryptocurrency, because in securities, wash sales, it's a rule that prevents you from taking a loss deduction and then buying back a security. Well, for example, say you sell a security at a loss, right? And you know that you've recognized the loss and you use it for tax purposes, right? But then you want to buy back the security because you want to like hold it because you know that it's going to appreciate in future value, So, and you buy it back. But if you do it within 30 days, it's going to be considered as a wash sale, and you won't get the recognition of a loss. So yeah, there's Section 1091. It actually does allow the IRS to expend, because for now the wash sale only pertains to stocks and securities, but Section 1091 does allow the IRS to expend that to cryptocurrencies. So that's something to keep in mind too. So using a retirement account for holding cryptocurrency, right? It depends, because IRAs, Roth IRAs, the contribution limit is like $5,500 or $6,500. So, and you can't contribute to a Roth IRA if your income is over $135,000. And the way, if you do have an IRA though, and you decide to put cryptocurrency in there, you can't transfer personal property to an IRA. So you have to set up an LLC. If you have an IRA, you can't just take cryptocurrency and like record it and put it in your IRA. You have to set up an LLC and formally do a transfer of asset to the LLC. Yeah, for solo 401ks, you need to be self-employed. To have no employees, usually a small business. A little note, there are things like GBTC, the trust, and Ethereum Classic trusts that are traded as stocks. You can do that too, and they have a good track record of appreciation, but it's a way, if you don't want to deal with setting up an LLC and transferring your assets there, you can just buy the trusts that are traded on exchanges and put them in your IRA retirement account. So with gifts, it's so long that the value of gifts doesn't exceed the $15,000 limit. That's for 2018. You don't need to report it. And there is no $15,000 limitation if you gift it to a spouse, political organization, charities, and tuition and medical costs. So you can use cryptocurrency to do that. So a little note, because if you go online, if you read like tax avoidance, like this is no tax avoidance presentation, but if you read stuff, if you go online, if you just Google, how to avoid taxes on cryptocurrency, of course you shouldn't do that. But a lot of websites will give you options, like foreign corporations, like foreign life insurance policies, and like giving up citizenship too. A note on that is if you do that and you can't prove that that was done only for a reason to avoid paying taxes in the US, you're going to be screwed, basically. And you're going to be prosecuted. So let's talk about opportunity zone funds, because that's a new thing in 2018. And by the end of 2018, it should get finalized, and IRS will issue further guidance at the end of 2018. Potentially, so basically, I'm going to show you a map of opportunity zones, and we'll talk about what they are. So basically, there is 8,700 opportunity zones in the United States right now. An opportunity zone, it allows you to postpone capital gains for 10 years. And after 10 years, you only pay 15% of taxes you were supposed to pay with capital gains. Basically, it's used for, like if you have millions of dollars of capital gains and you don't want to pay taxes on them, if you don't know where to put that money, you can later, in 2019 though, when you do a 2018 tax return, you can put those capital gains into opportunity zones, and the funds will be, the funds will be finalized in 2019, so you should be able to do that then. This is going to allow you to, let's go back to this. Yeah, you'll get basically 3 tax breaks. First, it's a deferral of tax until 2026. It's going to be a 15% reduction if you hold it until 2026. And after that, it's tax-free growth. So there is potential, because there's a lot of cryptocurrency startups that are happening right now. And there's a potential for the investors to kind of ride a tax-free wave, like a next Facebook or something, So definitely an interesting thing to look at for the 2018 tax year. So this puts us to an end of the presentation. Some closing remarks is that, do you remember that time, the 2017, the big appreciation of value that happened from the beginning of the year to the next, to the end? What happened, though, is there was a big bull market, and there was potentially like $25 billion of capital gains that could have been realized by the US taxpayers. So the IRS knows that, and they might pursue that. And then you got the John Doe summons. The Coinbase, there was a lawsuit against Coinbase, and in the end, the IRS won. And what happened there was Coinbase forwarded to the IRS and to the taxpayers information on taxpayers who completed trades from, I think it was a period from 2011 to 2015. If you completed over like $20,000 in a single transaction, then you will be subject to the John Doe summons, which they're called right now. I want to mention the AICPA and ABA letters, because they touch base on a lot of issues regarding hard forks and mining and like-kind exchanges too. And AICPA, I suggest you go and read that one, because it highlights the current issues that we don't have guidance on, but definitely something that needs to be addressed in the future. Okay, so does anybody have any questions? Yeah, sir in the back. Is there a microphone here? Yes.
On the John Doe summons, let's say you invested $20,000 in Lightning versus 167, and you held. At the end of the year, is there any tax consequences? Because now it's obviously not the same. What's the tax consequence on that?
Yeah, if you put over $20,000 in Litecoin back when it was 167, you said?
Right.
Yeah. It's a good question. I don't know about that. I think that's only if you sold. Actually, yeah, that's a good question. I don't even know.
Yeah, so my thought, if the IRS can say, hey, you potentially could have made this, can't we say, well, we potentially could have lost this much too?
That's a good point.
I guess like what you're saying is unless you sell, there's no tax consequence?
I don't know that for certain, but
okay.
Yeah, I wish I could answer your question right now. Sir?
Is also necessary to put all the? Is it necessary to put all the individual trades like on the Schedule D, and list them all?
Yes, all the trades, Bitcoin to Litecoin, Bitcoin to US dollar, needs to be put on Schedule D, as you said, the 8949 form. And good thing to point out is that, I mentioned the $25 billion of unrealized capital gains that could have occurred, but the IRS doesn't know about them. The thing about them is that there's only, I think it was like 800 people that reported cryptocurrency transactions in like 2015. So it's definitely, that the IRS knows about the fact that there's this many capital gains unrealized and unreported. So they might go back and track those people. But again, it's a risk-reward issue. So if it makes sense for them to spend that much money to pursue your past, then they're going to do it. So, but yeah, basically to answer your question, yeah, they have to be reported. Yes, sir?
In terms of legal structures, has there anything that's came out stating any tax advantages of setting up an S corp versus the LLC, or anything like that?
LLCs, the only fact they need to be set up for an IRA. If you do trading, if you do mining, and if it's like a big activity to you, you might want to set up an S corp or an LLC. But I don't see if you're just a small scale miner, you can just do a personal, like self-employment. Yeah.
We actually run out of time.
All right. Yeah, well, thank you very much.
Oh, thanks.
Yeah, can you put the slide back?
Sorry, we actually don't have time for that, but if you wanted to find the gentleman afterwards, and he might be able to give you a copy of the slides, if that's all right. Thank you so much.